There is a moment in every financial crisis that looks identical. The market is falling, the news is terrifying, and millions of people do the same thing at the same time. They sell everything and move into cash. It feels like the only rational move. It feels safe. It feels like survival. And for a while, it is. But history has a way of turning that feeling into one of the most expensive mistakes a person can make. The pattern repeats so consistently across centuries that it almost feels like a law of human nature. Crisis arrives. Cash becomes king. And then, quietly, without announcement, cash becomes the trap. In 1929, when the American stock market began its catastrophic collapse, the rush to cash was immediate and overwhelming. Banks were failing, factories were closing, unemployment was climbing toward 25%. Holding dollars felt like the only sane response to an insane world. And in the early years of the Depression, it actually worked. Prices were falling. Deflation made cash more powerful by the month. People who had moved to dollars watched their purchasing power grow, while equity holders watched theirs evaporate. The cash crowd felt vindicated. But then 1933 arrived. Franklin Roosevelt signed Executive Order 6102, making it illegal for American citizens to hold gold. The dollar was devalued. The rules changed overnight. The people who had been clutching their cash as a life raft suddenly found the life raft had a hole in it. The value locked inside those dollars had been quietly redistributed by policy. They had survived the crash, only to be slowly eroded by the government's response to it. This is the first lesson history keeps trying to teach. Cash protects you from the initial shock. It almost never protects you from what comes after. Move forward to the 1970s. The United States had just abandoned the gold standard entirely. Oil prices were spiking. Inflation was running hot, then hotter, then completely out of control. By the late 70s, inflation in America was touching 14% annually. Anyone who had moved to cash after the 1973 market crash, feeling clever and cautious, was watching their savings dissolve in real time. A dollar that could buy a full tank of gas in 1971 couldn't buy half a tank by 1979. The cash holders hadn't lost money on paper. They had lost something far more insidious. They had lost purchasing power. The number in their account stayed the same while the world around them repriced everything upward. They felt financially responsible. They were actually falling behind. The cruelest part is that the assets they had fled, stocks, real estate, commodities, were often rising precisely because inflation was rising. The thing they ran from was the thing that would have protected them. The thing they ran to was the thing that punished them. Germany in the early 1920s is the most extreme version of this story, and it deserves to be told slowly because it is almost impossible to believe. After World War I, Germany was buried under war reparations it could not pay. The government began printing money to cover its obligations. Inflation crept up, then walked, then ran, then sprinted into something economists call hyperinflation. By November 1923, one American dollar was worth 4 trillion German marks. People who had worked their entire lives and saved in cash, in marks, in the currency of their country, woke up to find their life savings couldn't buy a loaf of bread. There are photographs from that period of people using wheelbarrows to carry enough cash to purchase groceries. There are accounts of workers being paid twice a day so their wives could rush to the market at lunch before prices rose again by afternoon. The people who had moved to cash at the first sign of trouble, who had done what felt responsible and conservative, were wiped out completely. The people who had converted their savings into physical goods, foreign currency, farmland, or gold, were the ones who survived. Cash works when the crisis is a deflation. The cash fails catastrophically when the crisis becomes an inflation. And the brutal irony is that the government response to almost every major deflation in modern history has been to eventually create inflation. Japan gives us a slower, quieter version of the same tragedy. After the Japanese asset bubble collapsed in 1990, the country entered what became known as the Lost Decade, though it stretched far longer than a decade. Japanese households, deeply shaken by the collapse, moved enormous amounts of wealth into cash and low-yield savings accounts. It felt prudent. It felt Japanese. The culture had a word for it, tansu yokin, literally putting your savings in the dresser drawer. For years, the Japanese stock market continued to fall and cash holders felt smart. But the Bank of Japan held interest rates near zero for decades. The cash sitting in those dresser drawers earned almost nothing. Inflation was low, so the erosion was slow, but it was constant. And the opportunity cost was staggering. An entire generation of Japanese savers preserved the nominal number in their accounts while watching their real wealth quietly stagnate for 30 years. The crisis they feared never fully materialized. The slow bleed they didn't fear took everything they were trying to protect. The 2008 financial crisis produced a textbook version of this pattern in the modern world. When Lehman Brothers collapsed in September of that year, money market funds broke the buck. Credit markets froze, and the fear was total. Investors pulled hundreds of billions of dollars out of equities and into cash and treasury bills within weeks. The S&P 500 had already fallen significantly, and it would fall further, bottoming in March 2009. The people who moved to cash in the fall of 2008 had good instincts about the short-term direction of the market. But the Federal Reserve and the Treasury responded with the most aggressive monetary and fiscal intervention in American history since the New Deal. Interest rates were cut to zero. Quantitative easing was launched. The stock market began one of the longest bull runs ever recorded. The people who had fled to cash and stayed there through 2010, 2011, 2012, waiting for the other shoe to drop, waiting for it to feel safe again, missed a recovery that made the crash look small by comparison. The S&P 500 went on to rise over 400% from its 2009 low over the following decade. Cash holders preserved their capital. Equity holders rebuilt it and multiplied it. And there is a psychological mechanism at work here that is worth naming. Economists call it recency bias. The brain overweights what just happened and assumes it will continue. After a crash, the crash feels permanent. After a loss, more loss feels inevitable. So the investor who moves to cash after markets fall is not being irrational in the moment. They are being deeply, profoundly human. They are responding to pain by removing themselves from the source of pain. The problem is that markets are not the source of the pain. The source of the pain is the event that caused the crash. And that event, whatever it was, eventually passes. The market recovers. The cash holder, still waiting, still cautious, still watching for the all-clear signal that never quite arrives, misses the recovery almost entirely. The COVID-19 crash of March 2020 compressed this entire cycle into 33 days. The S&P 500 fell 34% in roughly a month. It was the fastest bear market in recorded history. The fear was genuine and rational. A global pandemic with no known treatment, no vaccine, and no clear end was shutting down the world's largest economies simultaneously. The rush to cash was enormous. And then, almost immediately, governments and central banks responded with an unprecedented flood of stimulus. By August 2020, the S&P 500 had fully recovered. By the end of the year, it was at record highs. The investors who moved to cash in March and waited for clarity were waiting while the recovery was already over. They had experienced the loss. They had missed the gain. What makes this pattern so durable across centuries is that it is not a story about stupidity. The people who moved to cash in 1929, in 1970s America, in Weimar Germany, in post-bubble Japan, in 2008, in 2020, were not foolish. Many of them were thoughtful, careful, experienced. They were doing exactly what their instincts and their fear told them to do. And their instincts were right about the danger. They were just wrong about the solution. Cash is not a neutral holding place. It is an asset like any other, with its own risks, its own vulnerabilities, its own way of losing value. The risk of cash is not visible the way the risk of a falling stock is visible. It doesn't show up as a red number on a brokerage statement. It shows up as a grocery bill that keeps climbing. It shows up as a rent increase you can't quite keep up with. It shows up as the slow, invisible gap between what your savings can buy today and what they could buy 5 years ago. This is why cash feels safe even when it is destroying you. The destruction is quiet. The destruction is gradual. The destruction doesn't look like a crash. It looks like ordinary life getting slightly more expensive every year. The investors who navigated these crises best were rarely the ones who moved fastest. They were the ones who understood that the real question was never whether to hold cash or not. The real question was always what comes after the crisis. What will governments do? What will central banks do? What will the policy response create? Because in the modern era, the policy response to almost every major financial crisis has been the same. More money, lower rates, more stimulus, and more money. Laid over time means less purchasing power for every dollar, mark, yen, or pound that is sitting in a drawer waiting for things to feel safe. There is a line attributed to the financier Bernard Baruch, who famously sold his stocks before the 1929 crash and preserved his fortune. He said he made his money by always selling too soon. What he meant was that he never tried to time the exact top or the exact bottom. He understood that precision was the enemy of survival. The investors who obsess over the perfect moment to get back in, who wait for the all clear, who need to feel certain before they act, are almost always waiting for a certainty that history never provides. The pattern across all 12 of these moments in financial history tells the same story from different angles. Crisis arrives. Cash feels like salvation. And then the world reprices itself around the people holding cash, and what felt like safety becomes the very thing that holds them back. The moment of maximum fear, the moment when cash feels most necessary and most justified, is almost always the moment that is closest to the turn. Not because markets are fair, not because recoveries are guaranteed, but because the forces that create crises also create the responses to crises. And those responses almost always involve making money cheaper, more abundant, and less valuable over time. Cash works, until it doesn't. And the tragedy is that by the time most people figure out it has stopped working, the opportunity to do something about it has already quietly passed them by.